Stream with bruv.
Right.
All right. Stream with bruv.
Right.
We're live, bruv. We're truly live, bruv.
We're truly live. Fantastic.
Go for it, bruv. Go for it.
All right. Good morning, good evening, good afternoon, you savages. It's the one and only Gorilla, and the main man, the cowboy himself, and we're rocking it out here on the YouTube free live of the lab. And I want to thank all you guys for following us over here. Listen, don't hesitate, don't procrastinate. Join algofactory.tech. Don't leave money on the table. Don't let money pass you by. Don't stop just sitting there. Do something about it, right? And, make a positive impact on your bottom line. Algofactory.tech. Let's get into it, cowboy.
All right, yeah, man. It's been an exciting morning. I was over hanging out in what's called the meme coin space, and so Ovi and I are kind of. There's some big players that want to touch that space, and so we're kind of helping get some data. So I spent the last 2.5 hours on the phone with kind of, I guess he wouldn't call himself an expert, but God knows what he's talking about. So I'm a little, what's the word? Like basically what's taking this guy a month to learn, I'm absorbing in 3 days. So it's really, my brain might be a little wonky at this point. But that's all right, because what I'm going to do is put the link up, or not the link, but the URL. So you can just go ahead and follow that and put that on the screen. And I'll let that sit up there. And we did have the Fed meeting yesterday, and it was kind of a nothing, I don't want to say nothing burger, but it was as expected. It's just not a lot of new data. And it's this, I would call it the second most market moving event of every given month at this point in currency markets, right? So you got the CPI, and we talked about that. I think it was last week, and it might have been the week before, but either way, basically the CPI is the consumer price index. It shows inflation. Inflation is the big topic right now, right? So, and why is inflation the big topic? Well, that's going to have to do with what the Fed does to the prime rate. And what the prime rate is where look, all the investment, like the vast majority of investment at this point is 90 some odd percent. I'm guessing, I don't know the number, but maybe you do know the number, but most investment is from borrowing. Like, you don't have a lot of people who have saved their money from their paycheck. You know what I mean? Like, you got a lot of big companies who are borrowing against their own corporate bonds to invest. I mean, what do you think that's in the 90 percentile?
Yeah.
I mean, that's the big money in the space, at least, is going to come from companies issuing debt, like, corporate paper, basically. And then they're borrowing against that debt to finance buying their own stock to push the price up. Well, here's the trick with that. As the interest rates have gone up, that borrowing has gotten more expensive, right? So when borrowing gets expensive, then now you have no yield. And we've been talking about, the Gorilla talks about yield, right? So a lot of what's happening in our country, when you have like basically zero or negative interest rates. Now, nominally, the interest rate was 2% or something, 1 point something. I mean, the interest rate existed. It wasn't zero nominally, but in reality, the interest rate was probably negative due to some factors when you factor in a lot of things. So essentially when you have a negative interest rate, the problem is that people don't want to keep their money in the bank. They want to take their money, they want to invest it in the market, because you can't make any money at the bank. Already, with all of the money printing and inflation, that's what causes the real rate to be negative, because your money is being eroded by inflation. And when you have, $7 trillion that we even talk about hitting the market during, say, 2020, that's just one part of why we had a lot of inflation. The other part of it, of course, is going to have to do with supply chains. And but long story short, we had an effective negative rate during that time. So people keeping the money in the bank's paying them 0.02% or something ridiculous, on their deposits. So nobody is going to want to keep their money in the bank because it can't make any return. There's no yield at that point, right? But if you take your money at that point and you put it into stocks, because everybody's putting their money into stocks or some other kind of asset during an asset like an inflationary period, you can get yield, because money is cheap and those things are going up due to inflationary pressures. Well, when you start to raise the rate, the yield in reality wasn't that much. It looked like a lot because the value of the dollar was decreasing. So you thought, oh, I'm getting 20% on this, but really because of the real inflation rate, you're probably getting closer to 5. Well, when the prime rate is raised up to 5, all of a sudden the best kind of yield you can get, especially in a dropping market, is going to be like single digit percent, right? And now you're borrowing single digit percent to get single digit percent yield, and essentially you're not making any money at all. And that's why the gorilla, talks about everything being yield starved, right here. And so, you want to talk a little bit about that so we can kind of explain to everybody what that yield starved conversation is and what it could lead to. That's more your territory than mine.
Yeah, so you have a lot of these banks and a lot of these investment companies and investment firms. Everybody's chasing the yield, right? They're looking for, think about it. They need the yield. That is whatever gains they can get in the market. It's the most important thing. They're having, high frequency trading algorithms, their computers. They're doing everything they can to squeeze profit. So when you're in a market right now, let's be honest here. You look at the Dow, right? In all honesty, you can fluff the numbers as much as you want, but there's no money going back into R&D. There's no money going back into corporate expansion. It's always debt issuance. It's always margin trading that is occurring. It is also insider trading that is also occurring. Now, insider trading, from every expert that tracks it, they are estimating insider trading right now at Wall Street to be as high as 400%.
And that's not even supposed to be legal, right?
Correct. It's not even legal. But this is what they're estimating. These are what professional firms are estimating right now. 400%. Margin trading is up 600%. Okay? These are not good numbers. These are not normal numbers. There's nothing normal about the economic cycle, the market cycles that we're in currently, or the market situation, environment that we're in. So these banks or these companies are not really generating real profits here. We know this whole thing is fictitious, right? We know that 106 million Americans are either unemployed or underemployed, and that number grows exponentially every single week, every single month. The reason why is there's a great deal of Americans now all of a sudden are mysteriously becoming injured. They're mysteriously working. Maybe they're practicing on the basketball court and they had a myocarditis or cardiac arrest. I don't know. But there's a great deal of Americans right now. When you look at there was a great statistic that was brought out by one of the guys. I forgot what his name was, but he's a former Wall Street guy, worked at BlackRock, no less. They look at insurers, right, and actuarials. And the insurance actuarials right now for disability benefits has skyrocketed. It was an insane number, like 139% increase year over year. And still, we're only halfway through the year and it's still moon shooting. In other words, the way the current trend is going in terms of disabilities, right, where they can't work. Something's happened to these people, millions. Something's happened to them where they can't work. We're expecting it to be over 300% before the end of the year. This is incredible. So all this stuff is happening. Wall Street can't do much. In other words, the equity market at 35,000 Dow, it's already been squeezed dry. It's very little juice left. This is why they need to inflate it to 40,000 Dow. This is why they need negative interest rates. This is why they need universal basic income. Why? All this helps artificially pump the market through negative feedback loops to create a little bit more yield for them to squeeze. Yield, think of yield as juice. Now, they need something else. And this is why all of a sudden CrackRock is like, oh, we like cryptos. We're going to apply for a spot Bitcoin ETF. And then you have that idiot woman who runs ARK Investments. Who's an idiot, an absolute idiot. She doesn't know shit.
Are you talking about Kathy Wood?
Yeah, I'm a fucking moron. Right? She's applying for the Bitcoin ETF, right? All the Fidelity, same thing. In the UK, the city of London is going full force with this. Why they want to do this is because they need something else to create the yield. Dude, I'll tell you right now, I know personally, yield-starved banks in Canada. Yield-starved. They would love to chomp into a crypto market, but because of government regs, this, that, and the other, and the unknown situation here in the United States, everybody's kind of like, kind of on the outside looking in, so to speak. But yield is the only thing they chase. Yield is the only thing that matters. It is the profit that they can squeeze out of the market. And as they're inflating, what's happening, right, and it's incredible. The higher the markets are inflated, the higher the equity prices are inflated, money velocity just seems to be petering off. And when you have money velocity just petering off and dropping to levels not seen since the 1970s, what that's telling you is screaming at you a red light. And that red light saying, we're in a solvency crisis. Wait a minute. Apple's $1 trillion company. How do we have solvency crisis? Amazon's $1 trillion company. We're in an era of $1 trillion companies with $1 trillion valuations. It's all bullshit. All bullshit. Solvency. 40% of the companies that are on the Dow make no money. They have no profits. So this is where we are, folks.
Well, $1 trillion company doesn't matter when, $10,000 buys you a loaf of bread in 2 years,
Exactly.
I mean, I'm exaggerating, but, you get it.
Yeah.
Well, as to how this affects trading, right? So we're in a situation where a lot of companies are being starved. We noticed that when the rates were hiked, eventually the market made a top and everything started to head down. They are still printing more money. So they're just printing it at a higher rate and handing it out to these companies. So essentially, the question is going to be, okay, so the way things work with these equities and these companies is that at the 2008 GFC, they were shored up with a bunch of paper, and that paper was issued at very low yields, right? So with that being the case, that was how things were at that time. After they're hiking the rates, the new paper is actually worth more than the old paper. But what it does is the new paper is worth kind of like, you could say, face amount, and the old paper is devalued, right? So all that money, quote unquote, all that paper, all that collateral that was there to shore up all these companies instantly gets cut into maybe 60%. I don't know the number, but it gets cut to less than what it was worth before, because the new paper being issued is now at a better premium. So, you're looking at a situation where you have a company that was short up at $100 billion. Now they're short up at, let's just say, $50 billion. Now they've lost half their collateral simply because the rates keep going up. And so companies are insolvent. So not only are they falling in the market, but they can't make any money because they're, first of all, not making any money. There's not any profit. They're just these zombie companies that are operating at possibly a loss, break even. But on top of that, their valuations are being eroded because of this continuing to hike the rate. But the difference is that I imagine, and I don't know for sure, but I imagine that the new paper is being kind of, is replacing the old paper to kind of keep these zombies alive. I imagine that's happening. But yesterday, the Fed meeting, which kind of took us into this conversation, there was a hike. It was a 25 basis point hike. I know I was thinking it would be a skip, but then I got some data and I called V yesterday. I'm like, I think they're going to hike 25 basis points because we need to know these things in our business. We need to at least have a decent forecast, and hike they did. So, we're looking at a situation where there's sort of, and I don't know if they mean to be doing it or not. I mean, there's, what's his name? Tom Luongo is of the opinion, I believe, that they are squeezing certain groups. And, if that is the case, it's happening whether they mean to do it or not. And yesterday was a 25 basis point hike. The actual terminology was non-committal is the way I'll use that. So it was along the lines that many of the meetings have been in the last like several months. It's going to be, hey, we're going to look at the data as it comes out. We're going to make a decision at that time. And that's, I mean, to me, that's obvious. That's what you do in business. You take a look at the data as it comes out. So it's just from what I read, because a lot of times I will not, like 9 times out of 10, I don't watch the pressers. I just, whatever, I don't care. Like, I'll read about it later. I have better things to do than to watch a predetermined statement, because I don't trade during those times. But the federal funds rate is now at 5.5%. And if you look at the top corner of the screen on the left, where is it? Shoot, it's not here. Let's go to news, market. Usually what I have on the top left is a comparison of the different rates. Here it is. Where did it go? The widget was right there. Let's see, metals, energy. Gosh, I don't know why it's not displaying, because it started to display. Well, at any rate, they also have a metals calendar, energy calendar, cryptos calendar, but this is, and I'll put this link in the description. It's forexfactory.com. Now, all this kind of data is going to be available in TradingView too. I don't know if it certainly is not going to be parsed out in this manner, but it's parsed out in its own way. So if you're using TradingView, which is what we use for our charting solution, then this data is also there, and it's a really cool solution. It puts it on the chart for you. I've showed that on the show before. But in essence, yesterday was an as expected priced in event. And what I mean by priced in was that when this happened, the charts just kind of, it's not like it was a big difference. We got more of a difference in price today based on this morning's data than we did yesterday. Yesterday, the price just continued in its same direction. Today, if I were to open up the chart here and zoom in for you, we'll just take a look at what happened as a result of the FOMC, right? Which is, generally going to be looked at as either the biggest or the second biggest event of the month. And yeah, so price just kind of continued in its same direction upward, right? So yesterday, it's the 26th at my time, noon, price just maybe got a little bit of a boost, but it just continued upwards. It just continued along the same direction. But now this data, the dollar just got really strong because the data that came out this morning was very optimistic, right? So we got the 6:30 a.m. that advanced GDP was a lot higher than expected. Now, are these real numbers? I don't know if they're real or not, but what matters is that these are the numbers that we're told, and how it's going to affect the market is what matters. Real or not, when you're in the matrix, if you get shot in the matrix, you die in real life too. That's like the way I look at this kind of stuff. So the unemployment claims themselves were also better than expected. It was less unemployment claims than expected, and advanced GDP was higher than expected. So whether or not these numbers are real or fudged, it doesn't matter. In the market, you're in the matrix, and you just play the game that there is to play. So now, of course, I don't trade these events generally. It's that to me is more akin to gambling. I'm a technical trader, so I always will look at the charts to make my decisions. But you can see here, this is the 3-hour chart. I'm going to roll down to the 5-minute chart just so you can see how the news actually affected the charts. So our news hit at 6:30. Then you can see that the price actually started to move down before that happened. And so it looks like people knew what was going to happen, because let me just verify that. 6:30 my time. Right, so that's why the reason that the charts moved before was because there were some European data that came out at 6:15. So that European data affected the EUR chart earlier. But if I were to go to say USD CAD, might give us a more pure read on the price action. And here it is, 6:30. It was just it looks like it was priced in, because at 6:30 the data made a hard move down, and it's already back to where it was as of now, which is 20 minutes later. So it played around. You had a bit of a whipsaw where price went up, probably scared some people into going long, and then it went short and stopped them out, and then now the shorts are getting stopped out. It's a bunch of whipsaw action. And this is why I tend not to trade these events, because I just wait for the event to pass. you do have the occasional scenario where, like, say the CPI is a little bit of a surprise, and then so the market flips direction, right? It happened last week a little bit. Was it last week or 2 weeks ago, whatever it was. But that's fine. I mean, I don't play news events, not until at least 15 to 30 minutes afterwards, at least. And then again, that's going to depend on the price action. But that's just the news for this week. And again, are these numbers real or not? Advanced GDP, unemployment claims. I mean, I can tell you that the numbers are certainly fudged just by the nature of how they're calculated. They're fudged. So that's that. Now we had the ECB press conference. Now later today at some point, not scheduled. It's going to supposedly happen today. Yeah, it is, but it's not necessarily scheduled. You got the Bank of Japan outlook and monetary policy statement, and so far the Japanese have not intervened. Their currency has been getting weaker and weaker and weaker. JPY pairs just like going up and up and up and up. No intervention as of yet. But you can see here, like, the dollar certainly got stronger as a result of the data this morning, and USD JPY really boosted up right there. And if I go to a higher time frame, you'll notice that the trend has just mostly been up over time. If you go back to, say, earlier in July, it's retracing from a hard move up. And really, if you go back to say May, even April, it's just been straight up since pretty much February. There's been very weak Japanese yen, and if you go back further, the same thing was happening last year too. So you have these big, massive moves up in the yen. We're talking very large percent moves up. This going back to to 2022. You went from 116 yen to the dollar all the way up to 150 yen to the dollar. You're talking about a 35 yen increase from 116 to 150. So 35, I don't know, was that 20%, 25%? That's big. In currencies, that's massive. The Japanese yen is a pretty volatile trade right now, but it has calmed down in the last it's pretty much calmed down a little bit. So we'll see what happens. Maybe the Japanese will intervene today, and we'll be able to see what they're going to do with their economy. And one thing about the yen to know is that historically, it's a safe haven for when stocks don't do so well. So, stocks have been doing really well. We're seeing all-time highs, not all-time, but we're seeing new local highs. And that's been going on for several weeks. And when stocks do well, money leaves the yen to go into stocks. So just another reason why the yen is weak, on top of their modern monetary theory. So, and the whole thing with trading is, if you know which way the wind is blowing, it's going to give you an idea of, what to do. Obviously, fundamentally, the Japanese yen is weak. So if you see your algos tell you that everything is flipping long, right, then your charts tell you long, and you know that the yen is weak in general because of these geopolitical or market issues, then you can kind of lean towards going to longs. You'll know that your time moving down is going to be limited. This was a strong move down, though, because there was actually a great interview with Tom Luongo and a few others last week. I'll see if, I don't know if did you see that interview with Luongo and those other guys? Alex, what's his name? Alex, is it Rayner?
Alex Craner?
Craner, yeah, it was Alex.
Oh boy, no, I missed that.
I'll send you a link to it.
Yeah, send me a link.
Yeah, I'll send it right now. So Tom it was really good work, because Tom always does good work.
Yeah, Tom's great, man.
Look, he talked about how the metrics that were given for, I think it was CPI, the way that the dollar moved, which we're seeing it on the chart right now. Just for the yen, you're looking at $1.45 all the way down to $1.37 within just like a week. Basically what he's saying is that the economy is based on spreads, and it spreads between the different rates for different sovereign currencies. And when the spreads get too wide, things break. So they actually had to bring the dollar into line. So they come out with this unemployment number that really should not have accounted for such a big change. But magically, the dollar kind of ends up where it needs to be to keep things from breaking. So he's just saying it's BS. It's all BS. And we say that enough times on here. So again, I think this morning's show is definitely with the data coming out at 6:30. There wasn't a whole lot to trade or talk about. I know Dr. Mulder has some questions on charts we'll get to in the private group. But for now, I just wanted to kind of make everybody aware of using the sort of geopolitical or at least geoeconomic knowledge to know which way the wind is blowing, so that when you do know which way the wind is blowing, you can back up your information by the algorithms to tell you when to enter and exit a trade. Because yesterday I entered and exited the same EUR/USD trade several times and just kept stacking little bits of money here and there because I knew which way the wind was blowing. It's just what I do. So that's a great thing to be able to do. So anyway, thanks for listening to me talk about all this stuff. I'm gonna throw again the link up here, and V, give us that gorilla send off.
All right, folks, listen, don't sit there and procrastinate. Join algofactory.tech. Look, one of the last exploits you have is trading. You learn this. You give us 6 months. You can work from anywhere in the world. You can be your boss. You can start a real change in your financial life. Join us, algofactory.tech. Cowboy, let's get into the members only, baby.